The PPI just came out and it is bad. It is very, very bad. 3.4% versus last month's 2.9%. The inflation crisis is getting worse. Inflation is surging while US economic growth just collapsed to a pathetic 0.7% for Q4 GDP. We need to talk about what this means for you. I'm going to cover three things in the next 5 minutes. First, how the mainstream media is trying to spin this inflation crisis as a temporary energy hiccup. Second, how Jerome Powell is completely paralyzed because cutting rates right now will just make things worse. And third, how this is all but confirms a 1970s style stagflation crisis and how Wall Street is preparing to use you as exit liquidity, allegedly. My name's Nick. I've been a professional investor and unprofessional trader for 24 years. Before I start, I'm not a financial advisor. This is not an inducement to buy or sell any assets. And most importantly, do not take financial advice from some random dude on YouTube. Now that the disclaimer's over, we can slow down. So, I've been thinking lately, it's been so long since we had a major economic crisis. Like 2008, that was the last one. And people are starting to believe it's never going to happen again. But before 2008, these things were quite common. 1966, most of the 1970s, 1980, 1984, 1987, 1989, 1991, 1998, 2000. I said I was going to slow down. Sorry, but 2007, 2008. So they used to happen very often. Then, since 2008, we've only had like minor hiccups. And that's been 18 years, and people are forgetting. And right now, if you turn on financial news, the narrative is perfectly unified. Oh, the show is going to go on. They're telling retail investors that the economy is resilient, and you should just aggressively buy the dip. They point to things like the new tax cuts or AI infrastructure, and tell you that growth is guaranteed for 2026. But then when the January producer price index came out, that was the previous one, showing 0.5% monthly increase, they told you not to worry. They say that it's just a temporary supply chain issue caused by, whatever. So they're just trying to push this message. Relax, keep buying equities and wait for the Fed to cut interest rates. And now PPI came in hot again, and the messaging is likely to be the same. But the underlying data is absolutely terrifying for US consumers and really for the whole world as a result. So let's talk about exactly why this is happening. While wholesale inflation is rising, the US Q4 GDP was just revised downward to a staggering 0.7% annualized growth rate. This is down from 4.4% in Q3, so that's massive deceleration. And many are saying that it would be much closer to 0%, so not 0.7, 0%, if it wasn't for AI's boost, which could evaporate soon, right? Economic productivity is grinding to a halt in the US. At the exact same time, core wholesale prices, which exclude food and energy, have surged. That is the literal textbook definition of stagflation. Prices are going up and growth is going... Oh, and I forgot, actually, unemployment is also rising. The US lost 92,000 jobs last month. So that's the textbook definition of stagflation. Prices are going up, growth is going down, the job market is getting worse. And the catalyst for most of this is sitting right in the middle of the Persian Gulf. That's just accelerated this thing that was probably already going to happen. The Strait of Hormuz is functionally paralyzed right now. That waterway handles roughly 20% of the world's daily oil supply. I mean, you've probably heard this before. Everyone said this a million times on YouTube. But because of this ongoing conflict, Gulf producers have they've shut down at least like 10 million barrels per day of output. Crude oil has spiked past $100 a barrel. Now it's sitting around 90 to 100. It just keeps going up and down a little bit. And when oil stays this high for too long, it acts as a massive, unavoidable tax on the entire global economy. Now, I do believe that probably oil is going to go down soon, but the damage is already done. That's the big problem. Because this destroys consumer spending. It drives up the cost of manufacturing, and it guarantees that inflation will not go down. It's going to go up. And not only does it raise food costs because it affects the entire supply chain, but also because 30% of the world's fertilizer flows through the Strait of Hormuz, which adds even more to the cost of food. Now, why do I say the damage is already done? I want to be clear about one thing. When oil goes up, the prices at the pump go up right away. When oil comes down, the prices at the pump, they stay high for quite some time. So consumers are screwed. Even if it goes down now, they're going to be screwed for the next month or two because there's a massive lag in taking prices down. Because do I need to explain why that is? Because they love to screw you. So anyway, Jerome Powell is trapped. If he cuts interest rates to save the dying economy, 0.7% GDP growth, he destroys the purchasing power of the dollar and ignites an inflation fire. If he holds or hikes rates to fight the oil shock, he bankrupts corporations and crashes the stock market. It's a dual mandate nightmare right now for him. And this is the exact same macroeconomic setup that we saw during the 1973 oil embargo. Back then, an energy shock paralyzed the economy and sent inflation surging to over 12%. The Federal Reserve had no idea how to handle this. They tried to balance growth and inflation inflation, and they failed miserably. The stock market got absolutely crushed. The Dow Jones lost over 45% of its nominal value between 1973 and 1974. That's an absurd number. The S&P dropped by about 40% in that same period. And that doesn't even factor in the real wealth destruction caused by double-digit inflation in that period. So your fiat savings are being destroyed from both sides in a situation like this. You lose purchasing power because of rising prices, while the broader economy slows down and kills your equity returns. The underlying mechanism today is exactly the same, and Wall Street knows this. While they tell you to buy the dip, they are actively preparing for a structural shift. Every bank has been releasing reports telling retail to buy the dip. It's all good now, just buy the dip. Look, I'm not a financial advisor, so I'm not allowed to tell you what to do, but they are allowed to, right? And they keep telling you to buy the dip. And whenever they say this, it tends to keep dipping. What a crazy world we live in, right? So you should really ask yourself, do you trust them? I would suggest doing your own research. Just look at what happened to precious metals during the 1970s stagflation crisis. Gold went from around $35 an ounce to a peak of like $850 an ounce. Silver went from under $2 to around $50. And stocks, well, they didn't do too well. The truth is, stagflation is likely here, and when the Federal Reserve is trapped like this, the paper pricing mechanism breaks down. So trusting paper assets is generally not a great idea in a situation like this. Wall Street wants you to hold the bag on overvalued equities while the economy stalls. So let's see how this plays out. I'll see you in the next one.